The ongoing drought in America is not the only reason for record corn prices. The American government has a renewable fuels mandate which says around 13 billion gallons of ethanol must be produced every year. This uses up more than 4.5 billion bushels of corn, which in this drought year is about 40% of all corn produced in America. Feedlots want corn, so do chicken and pork producers. If they can't get corn, they chase wheat and soybeans, and up go the prices. More on grain prices later on, but let's start today with cattle, where the price of grain is always an issue. But the biggest bear in the room at present is the rise of the Australian dollar. And it's not just the American dollar slipping, it's the euro as well. Now here's a graph of how our dollar has been travelling against the greenback and the euro. It's now at an all-time high against the euro, around 84.5 euro cents, and it's lifted an extraordinary 8% in the past 8 weeks against the American dollar. Now, how tough does that make business for processors and exporters? If you're selling to Japan or Taiwan, it's very tough. And I would think just as hard if the market is Europe. Beef Central newsletter is suggesting losses of $40 a head for grain-fed cattle and up to $100 a head for grass-fed ox. Let's see how cattle prices were last week. And the National Livestock Reporting Service says prices were mixed as an 11% drop in numbers bumped into reduced buyer demand. Some processors in the south have actually reported a cut in operating days. Cow prices fell, and the lift in feeder steer prices appears at odds with the dollar and the tight margins available there. Market chatter is suggesting some price pressure in coming weeks. The Eastern Market Indicator also held up well, closing firm at $3.88 a kilo. Now, the live trade is busy, boats heading to Indonesia and a couple a little further, Malaysia and the Philippines. Prices steady on last week, $2 for steers, and they're at a premium of 25 cents over heifers. Lamb numbers were also down for the week, while the sheep available lifted 14%. Quality is the key at this time of year. Most of the lambs on offer lacked finish, while the mutton market was pure numbers. Now to New York for cotton and sugar, and cotton performed OK given the macro conditions, while sugar looks fragile on the back of some positive harvest news out of Brazil. Now, cotton is usually the first commodity to suffer in an economic downturn, and maybe this is a signal of some sort of bottom. We'll see, and that sugar price is the lowest close for more than a month. Finally to grains prices now, and the profit takers were all over Chicago last week. Not surprising when you factor in the 47% hike in the wheat price from mid-June to mid-July. There's been a bit of a slump, but overall prices are only off 8% from the top. The only lift last week came with soybeans, and that's a new contract. China continues to book about 1 million tonnes of soybeans a week from the US and South America. The rumour mill now has the ethanol industry being politically targeted by the big users of corn. ASX futures were mixed last week. East Coast wheat followed Chicago, while some handy rain in the west put some glow into WA prices. Trading is said to be relatively quiet. It'll be interesting to see how the long-term impact of that rain, especially if any more falls in the west. Spot prices were firm, with canola finishing strongly. Sorghum continues its good run, and there's a growing confidence that canola has some upside. Now, the reason we closed the price check with grains is that last week the industry came together in Melbourne for its annual shindig. No doubt there were plenty of smiles because of the very good prices we've been having over the past several weeks, but grain growers are always thinking long-term, and apart from the usual weather and price gossip, the business focus was pointed sharply at productivity and blockages through infrastructure in Australia. It was also a chance to hear the view from North America. Now, Greg Costell looked at the end of the Canadian Wheat Board's export monopoly, and Alex Duncan, a leading commodity trader, covered a subject I touched on at the start of this report, the distorting effects of farm production being diverted to biofuels. Chris Clark spoke with both of them.
The use of ethanol in the U.S. market, and also biodiesel in the European market, consumes vast amounts of grain. We are using about 12% of the world grain production right now in biofuels, and what happens is that means we have no reserves, and we do have bad crops like what we have in the U.S. this year and the Black Sea growing areas. We create an instance where prices fluctuate very violently and very quickly, and we distort prices, and people in a position to move prices do move prices.
Can you give an idea of how distorted you think the ethanol production is?
If even in this year, which is arguably the worst drought ever on recorded history in the U.S., if you did not have ethanol mandates, prices probably would drop I'm guessing somewhere between 15 and 20% from their record levels. We would still have high prices because of the drought, but not nearly as high.
Do you think the US is likely to end mandated ethanol anytime soon?
I don't anticipate them changing for at least a few years. There's been a few governors in U.S. states that have asked that the mandates be relaxed. For this season, I see very little probability of that happening. There's not enough hurt yet.
So where does it have to hurt before things might change?
It's got to hurt the man in the street. It has to hurt at the supermarket shelf when you can't. I'm not sure what the price of beef here is in Australia, but a prime cut of beef is about $14 a pound for a fillet. When that price goes to $30 or $40 a pound, the price of milk goes from $3 a gallon to $10 a gallon, then we will see a political response. And that is not too far away if we have another drought somewhere in the world in the next 6 to 8 months.
What are the implications of that for Australian growers?
Well, the Australian grain producer has greatly benefited by first the initial subsidies for biofuels, and then now the mandates for biofuels in two major producing areas, which is the EU and in the US. So the Australian farmer has ridden the coattails of the biofuel boom around the world, and it's reflected in the price of land and in the price of commodities. So the farm community in Australia has done extremely well.
You also paint a picture of world stockpiles of grain at precarious levels.
Well, we've had poor production in South America, lost perhaps 50 million tons of grain production there this past spring and summer, and now we're going to lose about 100 million tons of grain production in the U.S. this coming season. We've lost 30 to 40 million tons of expected grain production in the Black Sea. So stocks to use ratio is going to be dreadful. And this is creating a massive rise in prices, world all-time record prices, particularly in corn. Not so much in wheat, because wheat is the one commodity that has had a good stockpile. But now we're going to feed more wheat than we have, and we're just going to reduce our stockpiles even more.
Greg Coster, what impact will the end of the Canadian wheat export monopoly have for Australian exporters?
Well, production isn't going to really change that much. We still have to, we'll grow it. It's just how it's marketed, where it's marketed. And when you look in an open market type environment, any commodity is now game to be moved, sold, bought on a first come, first serve, where previously everything revolved around wheat. So when I look specific to grain, I think because of cheaper ocean freight, because of the grain companies, they have ownership on the port and interior ownership, there will be a bias to use their Vancouver and Prince Rupert facilities, so probably another 10 to 15% more grain flowing that way. And a lot of that grain will compete in the Asian markets that an Australian entity would as well too. I think over time you're going to see a little bit more of a mid-quality type wheats, less high-quality spring wheats, and that's just due to the economies of scale. We've been producing too much high-quality wheat, or not getting the premium for it, and that mid-type quality wheat will compete with an Australian exporter on a more regular basis.
Have Canadian exporters been concerned about the end of the monopoly as Australian producers were?
Oh, sure. That was heat leak, contested debate. But I think now that it's in place, more are becoming of the opinion that, okay, the change is going to happen. Let's get on with it. And I think there is a openness, because prairie growers are used to marketing canola and specialty crops, so wheat's another transition. It's just the price signals and the basis and the connection with futures and the movement and the probable integration of buying according to milling attributes, just some of those changes that will evolve.
We've heard a lot recently about the impact in the US of drought. Just how bad is it?
When you put things into perspective of losing 100 million ton of corn and what that means, given the perceived inelastic demand base that has to be rationed with ethanol or livestock, what have you, and Canadian production in a normal year of all the major crops is 50, 60 million ton, well, that's like almost 2 of our crops. So yes, it is huge, and it really shifts the foundation to, or underscores Canada and Australia somewhat a follower to the leader, which either is South America or the U.S. And it's not only the soybean and the corn production adversity this year in the U.S., it's followed adversity in South America. 2011 soybean crop in the U.S. was smaller than normal. So you put all these things together, yeah, I think there's going to have to be some political sacrifices and some demand destructive type changes here in the next 6 months.